Let me begin with a slightly uncomfortable idea. Many people who feel financially stuck are not actually broke. They are leaking. Small habits are quietly draining their financial stability. And the difficulty is this. Most of these habits do not feel reckless. They often feel reasonable. Sometimes they even feel responsible. Today I want to show you 4 financial leaks that quietly weaken long-term stability. If these behaviors continue, they can gradually erode your financial position over the next few years. And there is a good chance you practiced at least one of them this week, possibly without noticing. We are living through unstable economic conditions. Inflation has been elevated. Markets move sharply. Layoffs happen unexpectedly. Interest rates shift. All of that is real. But long-term financial damage rarely begins with dramatic shocks. It usually begins with small internal habits that slowly erode margin. You may recognize this experience. Your income is higher than it was 3 or 4 years ago. Yet you do not feel materially safer. You read financial news and notice tension in your body. You delay reviewing your accounts because you expect discomfort. You tell yourself you will organize everything properly next quarter. I have observed this pattern across professionals, business owners, and families in multiple economic cycles. Interestingly, the people who build durable financial stability do not always earn the most. They tend to protect what others unintentionally allow to leak. I nearly drifted into this myself at one point. Income was strong. Things felt stable. So I relaxed slightly. Fixed costs crept upward. Investment structures remained loose. I postponed strengthening contingency reserves because nothing felt urgent. There was no crisis. But gradually something changed. My margin narrowed. Income had not fallen. Outflow had expanded. That experience clarified something important. Financial problems rarely begin with catastrophe. They begin with drift. Think of your finances like a boat. The economy is the weather. You cannot control the weather. But you can control whether there are small holes below the waterline. Most boats do not sink because of one large wave. They sink because water enters slowly and no one notices early enough. Later in this video, I will explain the most overlooked financial leak. Interestingly, even financially literate people underestimate it. But first, let us begin with the first leak. The first financial leak is lifestyle drift. Lifestyle drift occurs when spending expands automatically as income rises. There is usually no dramatic decision. It happens gradually. You upgrade a few subscriptions because they feel small. You move to a slightly more expensive area because it seems reasonable. You increase dining, travel, or convenient services because you worked hard. None of these decisions are inherently wrong. The issue is accumulation. Over time, lifestyle drift quietly reduces margin. And margin is what provides flexibility during uncertainty. When fixed costs become high, volatility feels heavier. If income dips, pressure appears quickly. To reduce lifestyle drift, a few practices can help. When income increases, delay lifestyle upgrades for a period of time. Allow raises to strengthen reserves or investments first. Direct a meaningful portion of income increases into liquidity or assets. Some people use 50% as a guide. Calculate your minimum stability number. This is the monthly cost required for core financial security. And review subscriptions periodically. Small recurring costs accumulate more than most people expect. Over time, these practices restore breathing room. The second financial leak is attention fragmentation. This happens when financial decisions become reactive because of constant noise. You read dramatic headlines. You hear confident predictions. You see commentary that makes action feel urgent. Gradually, your strategy becomes reactive. You sell after negative news. You buy after strong trends. You revise your plan repeatedly. The cost is subtle. Compounding becomes interrupted. Consistency weakens. Clarity disappears. Behavioral finance research shows that humans react more strongly to losses than to gains. This is known as loss aversion. It makes volatility feel more dangerous than it actually is. One solution is reducing financial noise. Set fixed review times. Quarterly reviews often work well. Avoid constant portfolio monitoring. Write down your investment principles. And automate contributions whenever possible. Automation removes emotional timing from the process. Over time, discipline often outperforms reaction. The third financial leak is deferred skill investment. This occurs when people postpone developing valuable skills because current demands feel urgent. You may delay learning about technological shifts such as artificial intelligence. You may postpone developing additional income capabilities because your job feels stable. You may neglect strategic relationships because they lack immediate payoff. The hidden cost is adaptability. When industries shift, optionality becomes limited. Economic history consistently shows that valuable individuals are those who continue adapting. To strengthen adaptability, consider a few habits. Allocate several hours each week to skill development. Choose one valuable capability to deepen each year. Create visible proof of competence through projects or case studies. Maintain a small number of strategic professional relationships. And occasionally test small income experiments. Over time, this builds optionality. Optionality increases financial resilience. Now we arrive at the most overlooked leak. Identity lag. Identity lag occurs when financial behavior reflects who you used to be, rather than who you are becoming. You may still think of yourself as someone who is not good with money, even though you now manage significant responsibilities. You may hesitate to invest confidently. You may underprice your work. You may avoid decisions that your current capability could handle. Psychological research consistently shows that identity shapes behavior. If you see yourself as financially uncertain, your behavior will often reflect that belief. One useful exercise is defining the financially competent version of yourself. What habits would that person follow? What standards would they maintain? What decisions would they make consistently? Then begin aligning your actions with that identity. Small shifts in identity often produce significant behavioral changes. Let us summarize the 4 financial leaks. Lifestyle drift. Attention fragmentation. Deferred skill investment. An identity lag. Economic volatility will continue. That is realistic. But structured financial systems tend to endure across cycles. When leaks are reduced, something subtle happens. The nervous system settles. Decision quality improves. And opportunities become clearer because pressure decreases. You are not someone waiting for luck. You are someone capable of building stability deliberately. If this perspective resonated with you, comment the word "Stop the Leaks." Writing it reinforces orientation. And if you value calm, structured frameworks for building financial resilience, consider subscribing. In the next video, we will explore how to build a 90-day financial stabilization system that restores clarity quickly. I will see you there.